Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 25th, 2012 edition of Market Outlook. So we had quite a quite a week this week. Market was up almost 4%, one of the biggest weekly gains we've had all year, and quite a bounce off the lows. So let's take a look at some of the key indices. We'll take a look at bonds, gold, and the market internals, and sort of do a quicker version this week, as I'm sure everyone's digesting their turkey, hopefully not asleep on too much tryptophan. So here we go. And again, don't forget to take our investor survey, and we'll mail you the results about the sentiment of our traders and constituents here at MarketGauge.com. So first of all, let's take a look at the Dow. If we look at the weekly chart, you can see we hit oversold regions on the weekly RSI. And at the same time, we hit the 65-week moving average, and that's rising. So overall, what I want to say is that the market is nicely intact overall. We did have a bit of a scare. It looked like the market was going to continue to drop, but good economic news, some good rumblings from Capitol Hill in terms of the fiscal cliff, and some better economic reports all led to some underpinnings here. But again, just looking at this thing technically, you can see that the RSI on the weekly charts coincided with a test of the rising 65-week moving average. Now let's take a look as well at the daily charts, because we have a slightly different picture here. Well, we moved up so quickly in a rather thin trading holiday half-day session on Friday that we're hitting overbought areas, as well as the sort of flattening to slightly declining 200-day moving average. So we also have this declining 50-day average to contend with. So we got this nice pop on this key reversal day here, which I think we had pointed out in our trading rooms this week and some of the other market reports. But nonetheless, this pretty vicious bounce and test of the 200-day, along with it being a bit in the overbought on a daily chart, certainly merits some caution here. If you didn't participate in this rally on the way up, I would look at this as a possible area to still consolidate. Again, major resistance should come in right around the 132 area, which coincides with this declining 50. Let's take a look at the spiders. Spiders are quite a bit stronger overall. Let's take a look. You can see here that the 65-week, we still didn't even get really close to it as we did in the Dow, which was quite a bit weaker. And as you can see, nice reversal this week after this sustained sell-off. So this was the first week that we've been up since 1, 2, 3, 4, 5, almost 6 weeks. This is the first up week that we've had in almost 2 months. So that is a nice change there. Overall, we're not overbought nor oversold on a price level on a weekly basis. Let's take a look at the daily chart and see what we have here. On a daily chart, interesting, we have early this week taken out the 200-day moving average, and notice that in the S&P, the 200-day moving average still rising. So you can see we're over 98 on the short-term RSI, and also approaching this 50-day moving average on the daily chart. So I would expect some pretty decent resistance, some backing and filling, and an overall positive environment here. We definitely have improved. Would like to see, obviously, this 50 days start turning around and moving to the upside. But nonetheless, we did have a nice reversal this week, moved above that 200-day moving average. Nice confirmation on Tuesday. Great follow through on the rest of the week, but a little bit cautious because of the short-term momentum has been so strong. Let's take a look at some of the market internals. First of all, one of the tips, or one of the tells on the decline last week and following the previous weeks was that even though the VIX was trading a little bit above or around the 200-day moving average, you can see that in terms of the Bollinger Band, the normal trading range, we really didn't get going. And so with that, fairly vicious sell-off, you can see the fear in the market just wasn't there. In fact, it hadn't exceeded the highs in the VIX since late August, early September. So that was quite interesting. Now, where the sentiment definitely has improved quite a bit. We've traded under the 200, now under the 50, but things have improved so fast that actually you're generating a potential caution here because you're trading beneath the Bollinger Band and back inside of it. So depending on how the market moves in the next day or two, that would signal a short-term sell signal in the market. So the sentiment got a little bit frothy here, a little irrational exuberance, and so there's a cautionary flag. So you got two things happening here. You got this really strong move approaching on a short-term basis, overbought, and the sentiment certainly has reached a pretty exuberant level as we hit the bottom of this Bollinger Band here. And so on a mean reverting indicator, this is pretty interesting, the fact that we've moved back inside. So if we can we start trading again above that 15.5 level in the VIX, that would sort of confirm at least a short-term cautionary flag, couple day correction, maybe a little bit more, but let's take a careful look, and being cautious here if you hadn't already participated in the rally is definitely prudent. Let's see some of the other market internal indicators. Well, right on cue, you can see that the McClellan oscillator, which is sort of our longer term for really active traders, this is good for a couple weeks, one week to a couple weeks out, and you can see we got to an oversold reading, and on Monday, or actually on Friday, it registered a buy signal, and of course we follow through nicely this week. Now on a shorter term basis, also you got really oversold, and again late Friday, early Monday, with that gap up, we sort of confirmed that the market had exhausted itself on the downside. You can see we moved on up-down volume through getting overbought, oversold. Now, once we pass through the 0.4 level in up-down volume after being beneath it, it generated a buy signal. And again, same thing, although you lagged a little bit on the advanced declines. But the thing that's interesting is we moved up so quickly, we're starting to approach, not quite there yet, but you're starting to approach the overbought levels. Of course, you can get more overbought until you turn down and that momentum switches. But the move has happened so quickly and so violently. Again, these other market internals are confirming that some caution here, if you're not already positioned with this rally, is merited. But with the S&P crossing the 200-day moving average, the key reversal pattern, or what we call the slingshot pattern, still in effect, look for some compression hopefully some consolidation to give you another opportunity to participate in a further year-end rally. And I just want to go back again quickly to the SPY, and you can see on this particular bar here on the 16th, you can see you made a new 60-day low and closed in the upper 25% of the trading range. And we did that on really pretty good volume. Not quite double. I mean, the average daily volume, 135 million for the spiders. We got up to about 250. So not quite double, but on a key reversal day, or what we call the slingshot pattern here, that's a pretty good sign that the price action had exhausted itself on the downside, and of course all the market internals confirm that as well. Now let's take a look at gold, because gold is starting to perk up and looking pretty decent also. And again, very strong seasonals this time of year. Also going into January, February, these are often the times where gold takes a pretty nice run and peaks out later in the first quarter of the following year. But nonetheless, you can see we had some compression. Friday's action, along with a lower dollar and stronger euro, attracted some buying into the gold market. And here you had a really nice rally. You still have a basically flat to slightly rising 50-day moving average, which we breached. So that sort of confirms a or tomorrow's action. If we can close above the 50-day moving average, it would confirm a phase change. So overall, gold looking really good, neither overbought nor oversold, so got plenty of room to move either way. And let's just go back and take a look at the longer term trend here. As you can see, we tested that 65-week moving average, held it nicely, and now consolidated for a couple of weeks and took out that 50-day moving average. So long term, can you argue about the overall trend in gold? No, very, very much intact, and looking for a potential another leg up. And again, the only fly in the ointment is you can see that the long-term monthly trend line going back to 2008 was breached, and you've got this return move and a throwback. So what we want to do is we really want to see this have a monthly close above 180, which would confirm a new high close on a monthly basis, plus a breakout above this trend line right here. So this return move still intact, but nonetheless, if you look at the daily charts, if you're looking at 180 as resistance, you're really talking about somewhere above here, and that is quite a nice move. You're talking from 169.60 all the way up to 180 or 181 level, almost a $100 move in gold bullion, which is equivalent to about 7 ATRs. That's pretty damn good. That's a nice size move. So let's take a look at, let's keep our eyes out on GLD for a follow-through move in this really mature bull market. So that sort of wraps up where we are overall in the markets. Again, markets looking firmer. Overall market internals for the stock market looking better, but on a short-term basis, getting a little rich. So if you're looking here, buy weakness in strong stocks, potentially look for some consolidation, compression to digest this rapid move up this week. Thanks. Have a great rest of your holiday weekend. And again, don't forget to sign up for this newsletter and at marketgauge.com and get this for free every week. Thanks, and bye for now.